I don't want to paint a more positive picture than actually exists. I mean, the market has been in a bit of a malaise. I think we've all witnessed that over the last week at minimum, Dr. J. Nor do I want to dismiss seasonality, which, right, Kramer was talking today, starts actually this period of pullback for stocks historically, and it's worked pretty well over the past 20 years. Not to mention, Doc, that today is quad witching, which you can explain to people why there's such interest in all of these expirations, why there's a thought that it could bring more volatility on a day like today, and we do have stocks down across the board. Can you explain that to people, please?
Sure. And Scott, I think the Michigan Sentiment Index today was a little negative. The fact that they're projecting up to a year out 4.7% inflation in that same sentiment index that the University of Michigan does, also a little reason to be softer in the market ahead of September 22nd. And then I think we're just fine. But to the quad witching topic, Judge, they separated out the S&P 500 from the other of the three, which makes four, of course. The S&P 500 closes on the opening prints of those constituent trades today. So that's already done. Then you've got options, index options and futures that close on the closing prints of all of these. And that's where in the past we had seen some pretty significant impact as people are trying to hedge that last minute. If all of a sudden there are not just $1 billion or $2 billion or $10 billion worth of stocks to buy or sell, but there are a lot more of that due to program trading and so forth. That's, again, why they separated out the opening print for the S&P 500. This still happens 4 times a year in the regular cycle. So September, the next one will be December and so forth. But not as much impact, Scott, since they've separated it out. And the markets are just a lot more efficient with humans out of the way for most of that, and most of it Virtu, GTS, DRW, the high frequency firms filling most of that paper that happens in those last few seconds of trade. But overall, I'm not bearish, Scott. I told you I thought that we would be sideways into the 22nd of September Fed announcement. I'd handicap it at 75 or 80%. That they're not going to announce the taper then, that will instead be in November. And that's because of soft things like Michigan sentiment, like the jobs report, and like, the softening of GDP and so forth. So I think that buys us a couple more months. And once we get to September 22nd, I think we go back to work to the upside.
All right. So, Jenny, on Wednesday, I did the show from the city at the SALT conference. Everybody on the panel, I think everybody, was kind of negative, except for Dubravko Lakos of JP Morgan, who came on and said, I don't know what you guys are talking about. Things are going to be good. He must have been listening to Farmer Jim Lebenthal. He raised his S&P price target for the end of the year to 4,700. Today, there's a cavalcade of positivity around the market, even on what's been a difficult week. JP Morgan on the technical says, so far the S&P pullback holds above a key trend support. We believe the index holds that support and rallies in the fourth quarter. All right, that's number one positive. Number two, Bank of America. Tina, there is no alternative. It remains a compelling argument, they say, for income investors to buy stocks. Not satisfied yet? All right, well, UBS comes out and says, we think this is a good environment for equities overall, and in particular for the energy and financial sectors. So whereas everybody seemed to be so negative, now to end the week, I feel like we're getting more positive, and there's Tom Lee right when you need him. Further evidence negative shocks are transitory, supports everything rally into year end. Jenny Harrington, I teed it up for you.
Thanks. So I'm wishy-washy. I'm in the middle, and the reason being is I hear all those bull case arguments, but I also see negatives out there. And actually, in a weird way, the negatives are this return to normal that I keep talking about. So think about what returning to normal is. Returning to normal is the Fed not pumping $120 billion into the market every month. We know tapering's coming, but until it does, we're going to have about $700 billion still pumped in probably. We know that 21 times valuation, like that's stiff. But to your Tina point, there is no alternative. The 1.3% 10-year Treasury props up valuations. So you've got this like push and pull, and we can just keep going and going. I am a full buyer of all of Jim's bull points.